Hi, this is CH. This video is part of a series of videos titled My ABCs, or Absolutely Biased Comments, to share how an individual investor like you and I can try to find out more about an investment fund from public sources and do some basic research or simple due diligence before deciding to buy the fund or walk away. Do explore the other funds covered in this series and subscribe to the channel if you find this video useful. Some quick disclaimers before we start. This is not a product sales pitch or a recommendation to buy. I'm not sponsored by anyone to do this video. Please do your own research and be clear about the product features and risks before taking any action. The information shown and mentioned in this video is accurate as of the date stated here. In this video, I will be talking about the Amundi Global Aggregate Bond Fund. This video is done as a follow-up request from a viewer's comment in my previous video covering the Amundi Index MSCI World Fund. If you would like me to cover any funds or ETFs, do drop me a comment in any of my videos and I'll be happy to work on it as long as I can find enough information on the product. Amundi Investment Solutions is a French asset management company founded in 2010 from the merger of the asset management businesses of Crédit Agricole and SocGen, two of the leading financial institutions in France. Crédit Agricole has 80% ownership of Amundi, while SocGen has 20%. Amundi IPO'd in 2015 in the Paris Euronext and has been growing strongly through organic business growth as well as multiple acquisitions. Today, Amundi manages over 2.2 trillion euros worth of assets, making it the largest asset manager in Europe. Amundi's fund offerings are generally decent in performance, with about 70% of the funds in first and second quartile Morningstar peers ranking for 1, 3, and 5-year periods. Amundi's businesses are well diversified. Client base covers the full spectrum from retail and private banking through third-party distributors, to insurers, to sovereigns and institutional. Europe, with France in particular, obviously covers the bulk of the business, though Amundi has been relatively successful in Asia with about 21% of AUM from the region. Product diversification-wise, about 30% are bond solutions, which is where the Amundi Global Aggregate Bond Fund falls under. The Amundi Global Aggregate Bond Fund is a sub-fund under the Amundi Funds fund family. Amundi Funds is set up as a Luxembourg SICAV company structure and is UCITS qualified. The fund is registered as a MAS recognized scheme, which means it is suitable for retail investors. The Singapore prospectus covers only a small subset of the sub-funds covered in this fund family, as not all funds are registered for offering in Singapore. Looking for fund manager information in the Amundi Singapore website is impossible. There is no mention at all in the fund webpage or fund documents, making it feel as if Amundi deliberately wants to keep the managers behind the scenes. As such, I have no choice but to rely on the information available on Morningstar. Based on Morningstar, the Amundi Global Aggregate Bond Fund is currently managed by Gregoire as the only fund manager since September 2022. LinkedIn shows he was promoted to CIO Global Fixed Income and Head of Aggregate Strategies at that same time. Gregoire has been in Amundi for 14 years and has been focusing on global credits all this while, so he is definitely well experienced for this fund. Prior to this, the fund was mainly managed for about 8 years by Laurent, who was, as per LinkedIn, was then the CIO for Global Fixed Income and Forex Strategies in the UK office. And the change happened probably because he decided to relocate to France to focus on Forex instead. I was able to find more names and faces in the European version of the fund fact sheet, where it lists 3 more portfolio managers besides Gregoire. So I'm assuming this is the full team that is co-managing the fund. There is, however, no bios or information on how well supported they are in terms of research analysts in the firm. The Amundi Global Aggregate Bond Fund strangely doesn't specify its investment objective and strategy in the fund webpage. It can be found in the fact sheet, but we will refer to the prospectus that contains more details. The objective of the fund is stated to focus on total return, that is a combination of income generation and capital growth, without prioritizing one over the other. I generally like bond funds to look at delivering good total return instead of trying to focus too much on high-yielding bonds at the risk of taking on too much volatility. ESG is a big thing in Europe, but Amundi is the first fund provider I see that talks about ESG before everything else in the investment strategy. In any case, those of you that have watched my past videos will know that I don't really talk about ESG aspects unless the fund is specifically running an ESG related strategy. Let's move on to the important stuff. It is stated that the fund invests mainly in investment grade bonds and money market instruments globally. By mainly, it really means at least 70%, which is stated further below, which inversely means the fund can have up to 30% high yield bond exposures. The fund invests at least 67% in OECD government bonds or corporate bonds. This sentence is a bit unclear, as it seems the corporate bonds do not have to be OECD origin. In any case, OECD comprise of 38 countries covering most of the regions in the world, so there is no problem fulfilling this criteria for a global bond fund strategy. There is also no currency constraints, so I would imagine FX management might be a component of returns generation as well. The fund has a limit of max 25% in Chinese local currency bonds and max 40% on a combination of securitized assets such as MBSs and ABSs plus European CLOs. There is also a max 25% in convertible bonds, max 10% in COCO bonds, max 10% in equities, and max 10% in other UCITS or UCI funds. These information are mixed up all over the place here, making it difficult to read and digest. I hope the folks who write fund prospectuses can make life a little bit easier for investors by organizing the information better. The prospectus goes on to talk about the fund benchmark, which is the Bloomberg Global Aggregate Index. The fund is base currency in US dollars, and therefore the US dollar hedged version of the index is used. It is clearly stated here that the benchmark is used not only as a reference, but is also a target for the fund to outperform. Given this is an actively managed fund, it is stated that it is likely for the fund to have significant deviation from the benchmark. Derivatives is used as an active investment strategy in the fund, and it is stated here the fund can short assets and markets. The fund has a limit of max 40% in credit derivatives to avoid evolving into a credit hedge fund strategy. The prospectus makes an effort to insert in an investment process section, but the content is miserable, as it is just a short one-line sentence. It implies the fund has long-term strategic positions plus short-term tactical bets, but there is no details on the mix and how the fund manager aims to balance the risks and returns of these two components. It is also mentioned the fund can arbitrage among credit, interest rate, and currencies, though again no details on how the arbitraging might be done. The one useful point for investors new to bond funds is that it is common for bond funds to look at credit, interest rate, and currencies as three separate but related components to manage. Some bigger teams may allocate different members to focus on each of these three components in a fund. One additional information found in the Luxembourg prospectus but missing in the Singapore prospectus is that the fund is expected to have a gross leverage of 700%. This is to cater for the active usage of derivatives in the fund. While the number looks quite large, the fund doesn't report the actual leverage levels in the portfolio at all in the fact sheet and webpage, so we wouldn't know whether this is a concern. That's all there is in terms of investment strategy and process for the fund. So let's look at the actual portfolio next. The Amundi Singapore website is not very well maintained in terms of its documents. It took me a while to realize the fact sheets in some of the share class web pages are not updated, and they are still showing a very outdated commentary document. The portfolio data available in the Singapore website is also slightly different from the Europe website, so I'll be grabbing data from both websites as we go through the fund portfolio. The fund was launched in 2007, although the share classes available in Singapore were incepted in 2015 to 2016. It has a decently large AUM at about 4.5 billion US dollars or 3.86 billion euros. The Singapore webpage is missing the millions indicator if you happen to visit it. The portfolio data available in the fund webpage is not really retail investor friendly. This is what is termed as main lines, which is really top 10 holdings by issuer, where we can see mostly country names and implies these are mostly sovereign bonds. We can't get too much info here except it is useful to note US sovereigns exposure looks to be pretty low at only about 6.3%, which is quite different from most other global bond funds. The Singapore webpage also provides geographical breakdown versus benchmark, which is a little bit more useful. Here, we can see the US exposure is about 22%, and that given we know US sovereigns is only 6%, this implies the other 16% are likely corporate bonds and maybe securitized assets. In any case, the US exposure is still significantly lower than the benchmark of about 40%. In exchange, there are significant overweights in various European countries, as well as Brazil. I suspect there is some form of home bias here, as the fund managers are based in Europe and are probably more proficient in seeking investment opportunities in Europe. The Europe webpage instead provides credit rating breakdown versus benchmark, which is also useful. Here, we can see the fund has only about 13% in high yield credit rating, so the fund is not really taking too much credit risk to try to obtain higher yields. The big difference in AA rating versus benchmark is due to the low US exposure, which I think is still fine as the fund has decent levels of AAA and single A rating exposures. The higher BBB exposure is probably to try to get more yield at the fringe of investment grade rating. The Europe webpage also has a sector allocation breakdown versus benchmark. However, the numbers presented here looks quite odd. I suspect this is actually referring to duration breakdown by sector, but I won't comment on this as there is no explanation or clarification on what this data really is. The fund fact sheet, however, provides a detailed and interesting sector allocation breakdown versus benchmark. Interesting because I have not seen this way of categorization from any other fund providers, where financials are carved out as a separate category and sovereigns are split into many different layers. Let's start with sovereign bonds. Adding up all the sovereign-related exposures total to about 64.73%. So roughly speaking, the fund currently is about 2/3 sovereigns and 1/3 corporates exposure. Emerging market sovereign local and hard currency debt totals 14.42%, which is quite sizable compared to other global bond funds in the market. Lastly, while it appears that there are no direct securitized assets in the portfolio, the fund does hold about 9% TBA, which is mentioned earlier in the prospectus that would normally be MBS or ABS as well. Let's look at corporate bonds next. The underweight in sovereign bonds versus the benchmark is translated to a sizable allocation to bank issues at 22.42%. However, there is no further breakdown, so we can't really tell how much of these are normal bonds versus special financial bonds like CoCo bonds and so on. The rest of the corporate sector exposures are quite small and therefore are not significantly different from the benchmark. There is a very small interest rate swap exposure mentioned, but there are no further details available on the usage of derivatives and the current portfolio leverage. The fund fact sheet also indicates the portfolio yield is currently 6.21% and the modified duration is 7.41 years, both which are notably higher than the benchmark. Average credit rating is a notch lower than the benchmark at single A, which is still decently high. That's all the data available from Amundi, so let's see what else we can find from Morningstar. Morningstar shows the net, short, and long exposures by asset allocation, where we can see there is not much direct shorts on bonds, but the gross exposures of both short cash and long cash are quite substantial. This implies there is quite a lot of derivatives deployed in the portfolio, however, we won't know the details. Morningstar also provides some breakdown graphs that can give some insight on the type of risk that the fund might take on. For example, it can be seen that more than half of the high yield exposure is actually under sovereign bonds asset class instead of corporate bonds. These high yield sovereigns appear to be able to have 10% to 20% yield to worst, so they are definitely very attractive from yield perspective. So it would be important for the fund manager to be able to assess the positions actively and manage the risk well to avoid distress or default situations. Last but not least, Morningstar also provides a more comprehensive geographic region breakdown, where we can calculate that Europe region totals to 59% of the portfolio. So this is definitely a very Europe-heavy bond portfolio. As mentioned earlier, the Amundi Global Aggregate Bond Fund was incepted in 2007, but the share classes offered in Singapore were only launched in 2015 and 2016. Currency-wise, only US dollars and Sing dollar classes are offered in Singapore. The fund has many other share classes as well as currency classes, including Swiss franc, euros, and sterling, though these are not available for Singapore retail investors. The available share classes are A2 class, which is a code that means retail share class offered in Asia only. The bracket C means capitalization or accumulation class, while bracket D means distribution class. The Sing dollar classes come in both currency hedged and unhedged versions. We'll take a look at the performance differences later. All the distribution classes are MTD types. M stands for monthly distribution frequency, T stands for target dividend, and D stands for distribution. Target dividend means the share class aims to fix the distribution dollar amount or percentage, which is essentially the same as the smoothened payout method stated by most other funds. It is clearly mentioned in the prospectus that the distribution classes may use some capital and capital gains to make up the distribution, which means the distribution amount is likely higher than the natural coupon income generated in the portfolio. We'll take a look at the distribution details later. A2 classes have a 0.95% management fee. Adding other expenses gives a total expense ratio or TER of 1.23%. Up to 60% of the management fee can be paid by Amundi to distributors as trailer fees. Distributors are allowed to charge up to 4.5% subscription fee for the fund, although I think anything more than 2% for mutual funds is excessive. In particular, with bond funds that do not generate too much return in the first place, I think 1% or lower would make better sense for investors. The distribution history of the share classes is available in the fund webpage, although it is combined with the daily NAV, so it is quite troublesome to just look for distribution data. There is also no distribution yield data available anywhere, so we will have to calculate it out ourselves. So here we go. I have extracted the 12 months of distribution data for the 3 distribution share classes available for offering in Singapore. I've grabbed both the NAV and distribution dollar value so that we can calculate the distribution yield percentage for each month, which as seen here has small fluctuations. The approach the fund has taken in terms of target distribution is to keep the distribution dollar value constant and revise it if the market conditions change meaningfully. We can see there was one round of revision done in January this year. We can also estimate an annualized yield by summing the 12 months worth of distributions, then divide it by the latest NAV to get a 12-month yield percentage. Here, it appears the distribution yield is set at around 5% for both the US dollar and Sing dollar hedge classes. This means the currency hedging cost is factored into the NAV for the Sing dollar hedge classes. It is also interesting to note that during the revision in January, the distribution for Sing dollar hedge class was revised down, but the distribution for Sing dollar unhedged class was revised up. As a result, the Sing dollar unhedged class has a slightly higher distribution yield currently. However, we will need to look at total returns to see which share class really has a better performance. The Amundi Global Aggregate Bond Fund provides a dynamic performance chart with editable start and end dates on the share class webpage that compares against the benchmark, which is a nice and useful feature for investors. There is, however, no other performance information available on the webpage. The fact sheet does provide annualized performance data across various time periods and against the benchmark. However, the Singapore fact sheet only shows annualized performance data for Sing dollar share class and doesn't have calendar year performance. The Europe fact sheet, on the other hand, provides cumulative performance data across time period as well as calendar year data, so this would be much more useful to review the fund in US dollar terms. Based on this data, we can see the fund has managed to deliver about 1% per annum outperformance in 1, 3, and 5-year periods. However, the since inception period, which is about 10 years, show nearly identical returns as the benchmark, with a slight underperformance, which is not great. The other thing we can see is that the performance of the fund in the long run doesn't seem to be able to sustain a 5% distribution yield, so it is likely some capital had been sacrificed through the years for the distribution share classes. From the calendar year performance, we can also see the fund can actually be quite volatile and deliver returns with big fluctuations, from a plus 10.8% in 2019 to a minus 9.1% in 2022, which looks roughly in line with how the market had behaved. Given the fund's strategy is rather flexible and deploys quite a lot of derivatives, the fund appears to have done better than the benchmark in both years. In any case, investors should be prepared to expect such return variations if considering this fund. Separately, 2020 was also an interesting year, which can only be observed properly by looking at the performance chart. The fund fell more than 10% in March 2020 as COVID announcements crashed the markets. This was a much more severe correction than the benchmark, though fortunately, the fund managed to recover through the rest of the year to deliver a slight positive return. Let's compare the fund with some of the popular global bond funds in the market, such as BlackRock Fixed Income Global Opportunities, JP Morgan Income, Jupiter Dynamic Bond, M&G Optimal Income, and PIMCO GIS Income. On this 10-year chart, we can see the funds kind of fall into two categories, and the differences in returns look quite significant. PIMCO, M&G, and JP Morgan are the better performers, while BlackRock, Jupiter, and Amundi are the weaker performers. If we change the time period shorter to 3 years, the two categories are still present, though JP Morgan has moved down to the weaker category. The funds in each category tend to exhibit very similar performances, so there is clearly something PIMCO and M&G are doing right that the others are not. Lastly, shortening the time period to 1 year, the fund performance differences becomes less obvious. We can see M&G and Jupiter are very similar and behaving much more volatile than the others, so they might have taken a similar investment view that is different from the others. The others are less distinct, and Amundi ends up with an average performance among the pack. These charts suggest that Amundi Global Aggregate Bond Fund hasn't really been a great product in terms of performance considerations. Perhaps the strategy is too risk-averse, or perhaps the Europe bias has a negative impact. In any case, the fund manager and investment team needs to figure out how to improve the fund performance to better attract investors. On a separate note, Amundi also launched in 2022 a passive indexing product tracking the same Bloomberg Global Aggregate Bond Index. I'm not sure whether there is any product cannibalization between the two Amundi funds, but the active fund appears to be doing slightly better, so it shows active management in bond funds is still relevant. For Sing Dollar investors, the fund offers both currency hedged and unhedged share classes to pick and choose. Historically, the Sing Dollar hedge class has lagged behind the US dollar class by about 1% per annum, which translates to the hedging cost involved. Now this is problematic for a fund that doesn't have a high returns track record in the long run. Based on Morningstar, annualized data for the past 10 years, the US dollar class delivered 2.23% per annum, while the Sing Dollar hedge class delivered 1.53% per annum. These are pretty low return numbers that probably won't attract Sing Dollar investors. The Sing Dollar unhedged class, on the other hand, has exhibited quite different performance track record through the years as a result of the FX fluctuation, and interestingly ended up with around the same returns as the Sing Dollar hedge class in this chart. So there hasn't really been any notable advantage going for the Sing Dollar unhedged class. The low returns of the fund with the seemingly unsustainable distribution yield also warrants a look at NAV history. For the US dollar class, we can see it originally intended to keep the NAV in the range of $95 to $100. The COVID years then brought about market chaos and volatility in the NAV. Post-COVID, the fund now appears to be keeping the NAV in a new range of $90 to $95. So there was some capital loss during the COVID period, but it appears the fund has found a footing in the past 2 to 3 years and is able to maintain the NAV at current distribution yield levels. This, however, also means there is no capital growth expectations as the share class seems to be distributing out all its returns. The Sing dollar hedge class, on the other hand, has the additional problem of currency hedging costs. If all the returns generated in the portfolio are paid out as distributions, then the currency hedging cost will definitely drag down the NAV over time. This is clearly visible when we look at both the old and new NAV ranges that show a progressive decline over time. So Sing dollar investors need to be aware of this. With that, let's summarize our findings. Amundi is an established global asset management firm and the largest asset manager in Europe. About 30% of its AUM is in bond solutions, where the Amundi Global Aggregate Bond Fund falls under. While the manager information is severely lacking from Amundi, the fund appears to be an important enough product to be managed by the CIO Global Fixed Income. The fund objective and strategy is quite clearly stated. This is an actively managed global diversified bond strategy with an investment-grade focus. There is a heavy Europe bias and a sizable amount of derivatives seems to be used in the portfolio. The investment process, however, is not elaborated, so it is difficult for investors to understand how the fund is really being managed and operated. Actual portfolio data and information need some tidying up from Amundi. There are big differences in the data available comparing Singapore website and documents versus Europe versions. It doesn't make sense for investors to have to go to multiple sources to get basic essential information of a fund. The fund performance is a concern. In the long run, the fund hasn't really outperformed the benchmark and peers, and bouts of volatility in its track record further lessens its viability as a top pick for investors. The relatively low performance also brings about the question whether the fund can sustain its distribution yield, even though it is not among the peers with higher payout yields. While it appears the NAV is currently contained within a range, there is no capital gains for the distribution share classes with the current yield level of around 5%. In conclusion, while the fund's positioning differentiates it from the other popular global diversified bond funds in the market, the performance of the fund is a key detractor for investors. The fund managers need to figure out how to improve the returns in order to make this fund more competitive. This concludes my absolutely biased comments on the Amundi Global Aggregate Bond Fund. Again, if you find this video useful and would like to see more related contents, please subscribe to the channel. Thank you and have a great day.